Hey traders, happy New Year's. This is Blake Morrow with Trader Summit, and I have with us, it's this week and it's Friday. I have Mr. Jim Welsh of Macro Tides. Let's bring him on in. Jim, how are you? Happy New Year.
Hey, thank you, Blake. Happy New Year to you and all of the wonderful viewers. I wish everyone a healthy 2024.
Absolutely. Jim, it's funny. I say funny. This week's price action, I want to say there's maybe lack of liquidity, but we've seen a very big move or a lot of big moves in the markets. And some of the stuff that I was anticipating over the next couple of weeks, me personally, have
Mhm.
happened already this week. And it's like, wow, that's fast.
Yeah,
How did you take the reaction to today's jobs report and then ISM that
yeah.
came out?
Well, I'm glad you added the ISM
Mhm.
because that acted as the ISM report came in quite a bit weaker than expected.
Yeah.
Not much above 50, which is the demarcation line between expansion and contraction. Services are 80% of GDP, goods are 15, just to put it in perspective. So initially we saw Treasury yields spike up, S&P futures dropped, and in reaction to the top line jobs number, that started to moderate when people looked under the surface and said, "Wow, they subtracted more jobs." I think 10 out of the last 11 employment reports, Blake, they come out with the number, and then a month or two later, all of a sudden they're shaving a decent amount of jobs from that headline number. So if the accurate number came out, we'd have less reaction to it. So hourly earnings were up, which was a negative. That was part of the initial reaction. So I think the markets were already reacting or rebounding from the initial knee-jerk reaction. And then when this ISM Services number came out, and I think it goes to members 15 minutes before, well, 15 minutes after the market opened, and then on CNBC, it's released broadly at 7 o'clock or 30 minutes. And that's when we saw, ooh, the S&P really pop, Treasury yields dip more, and so forth. So I think a lot of people just said, okay, great. When you add it all up, we still have okay job growth, and but not so much as to maybe really worry the Fed.
Yeah.
Now, it is in fact taking away the idea that a March cut is coming. But as I said in my letters, and probably when we talked last week, if you don't get a March cut, Wall Street will look at, okay, we didn't get it in March, but we'll probably get it in May. They'll put that happy spin on it. So that really was the 1-2 reaction to two different data sets. One implied more strength than it really did on the surface, and then the ISM number was clearly a pretty soft number.
I think coming into the data, the market was looking at maybe like a 70% chance of a rate cut for March.
March.
Then after the non-farm payroll went down to like 50%. Then after the ISM, it's back up to like 70%. But like all in all, do you think it was more of a wash, and the market's still anticipating a rate cut going into March then?
Well, again, the bigger picture is I think people are looking for, irrespective of a March cut per se,
Mhm.
oh, the Fed's going to be cutting. Again, Wall Street's at 6 rate cuts. The Fed, the SEP projections are for 3. So Wall Street is still very much not on the same page as the Fed. So again, the dynamic here is, okay, we may not get 6, we'll get 5. We may not get it in March, but we'll get it in May. So it dented the narrative of no recession, earnings up 12%, and the Fed's going to be cutting rates. It doesn't get any more bullish than that. And
Yeah.
I think that, will remain intact. That was my expectation coming into this week, that we'd see a dip early in the year. Everybody's so bullish that that dip would be considered, oh, a gift, and therefore buy the dip.
All right. Well, with that being said, with this new year, the volatility that we're seeing, I want to jump into your charts and
Yep.
and talk about some of the things that you brought to the table this week. And the first chart that you brought here is well, tell us what we're looking at here, Jim.
Okay. Basically, this is a poll that was done by Bloomberg, and they found that in December, only 32% of economists are looking for a recession. Now, in December of 2022, it was 85% of economists were looking for a recession in 2023. So, again, I lean toward being a contrarian. So, when you have 85% of any group expecting a certain outcome, you gotta have to fade it. But of course, you need, information and data points to support that. And so last year, I did not think there was a recession in 2022. I didn't think there would be one, that the economy would be fine through the first half of the year. And now we've seen the pendulum where only 32% expect a recession. So I continue to think that the first part of this year, from an economic standpoint, is going to be okay. And I discussed this at length in the January Macro Tides. But I do think the lag effects from all the tightening that took place is going to have an impact on the economy. And we are going to see a very market slowdown. I think there will be at least 1 quarter of negative GDP growth later on this year. It might be the second half, but I'm just bringing this up in terms of 85% last year said recession. In effect, we have 68%, more than 2 out of 3 saying, oh, we don't have to worry about a recession.
Yeah.
And to me, that's like, okay, I want to fade that, but I need evidence. And, right now the evidence is the economy is still doing okay, and job growth is okay. Wage growth is obviously good. Consumers still have excess savings based on an updated number of excess savings by the San Francisco Fed. So there's all these reasons, Blake, why the economy, I think, is going to have forward momentum going into 2024. It's just not going to dissipate very quickly.
All right. Well, now that we're kind of past the jobs and I think that's probably one of the reasons why, Jim, that the markets found buyers today as we dip below the 4,700 level in the S&P is because, the economy it may be slowing, but it's not, there's job growth, right? So
there's nothing materially changing the narrative.
Okay.
That we're not going to have a recession, earnings are going to be up, and yes, the Fed's going to cut rates.
Well, so next week we have probably the most important data of the month coming in at least ahead of the Fed, is we have the CPI data. So the next chart you brought is referencing CPI, the next 2 charts actually. So what are we looking at here?
Okay. Well, there should be, we'll see when you get to the next chart, because there was a second chart about the 17-year cycle. But since we're talking about the CPI, we'll look at that and we'll figure out the other part. Okay. So again, the CPI is a 12-month rate of change. So it's like, okay, what are we taking away from December of 2022? On the headline, it's 0.1%. On the core, it's 0.4. So now you drop down to the bottom line. Well, what did the CPI do in November? Well, it was up 0.1. If you get a repeat performance where you're taking away 0.1 and adding 0.1, the CPI won't drop. It'll stay right where it is. And so the headline number, which has been, kind of goosing people in terms of, oh my God, it's falling so much. I think that, it's like, oh, okay, it didn't drop that much. The core, the ad from November was 0.3. So potentially the core will drop by 0.1 or so. But my only point is the CPI numbers have been very, very supportive of the narrative that, hey, the Fed can cut the rates. Well, if you just see a slowdown in the amount that inflation is falling by the CPI, it's kind of like, okay, again, does it take away the idea of a rate cut in March? I think so. And then Wall Street has to start to, I think, deal with that. So that's all. So to me, the CPI comes out, I think, next Thursday. And my anticipation here is we're going to see very little movement, maybe a downward tick by 0.1 on both the CPI headline and the core.
So the next chart you brought, Jim, is the 17-year cycle. Can you explain to us what this chart represents?
Okay, basically this table shows going back to 1939 that the market has hit kind of an important high every 17 years. So 1939, 1956, 73, 90, and 2007.
And you're talking the S&P in general, not
Totally S&P 500. That's
okay.
why it shows the prices. Now it's kind of trippy when you go back to 1935 or
Yeah.
39 and you see yeah, the S&P was at 13.10, you know, compared to, 4,700.
That is wild.
It kind of is. And in some of these cycles, you had very sharp breaks. And then in a number of cases, the 17-year cycle led to 2 years of not great performance by the S&P. So obviously 17 years from 2007 is 2024. So my point here is this pattern has been really pretty consistent in terms of there being pretty decent sized declines after a cycle high. So what we want to be able to do is use current technical analysis, momentum tools, and so forth, as well as, okay, what are the economic assumptions? Are they going to prove right or wrong? What are the assumptions regarding monetary policy? Prove right or wrong? And boil this together, because if this cycle is going to operate in 2024 and 2025, potentially, it's going to be because the assumptions were wrong and the underlying technical aspects of the market, which have been pretty healthy over the last 2 months, are going to show deterioration. And so to me, this is like, all right, I think something's coming, and we need to rely on technical analysis to hopefully pinpoint when a high is being made. And if some of the assumptions regarding the economy and monetary policy are indeed proven wrong, as I think they will be, that would be the reason and justification for selling pressure to pick up materially in 2024 and potentially 2025.
So Jim, so the crash of 1987, it's not on here. It doesn't register.
No.
So
no. Well, again, it's every 17 years. So we're not looking for big declines and then trying to fit it into a time frame per se. It's what are the time frames? Okay. And again, 1998 isn't on here. Well, there was a pretty big decline in 1998.
Yeah.
There, of course, been other bear markets. 1970, down 30%. Okay. So, big declines happen outside of a 17-year window.
Yeah, that's a great point. And
yeah, so it to me just says, hey, folks, everyone's bullish, optimistic, and this should cause pause in terms of, okay, do I want to get swept up in all this bullishness blindly? And the answer should be absolutely no.
Yeah. All right. Well, Jim, the next question I'm going to have for you, and I think that was a really interesting cycle chart that you brought, is what does that mean for the dollar? And what does that mean for the rest of the markets? Because, the dollar, has obviously rallied this week. I think there's a little bit of a reversion to the mean type of trade, following the end of year flows. But does that mean that we're going to have more dollar gains?
Probably not in the very, very short term. Let me add one thing. In the January 2nd weekly technical review, Blake, I had that table on the 17-year cycle in there.
Yes.
But I also had charts of the S&P covering the 1939, 56, 73, 90, 2007. So you could kind of really, take that table and then actually look at a live chart. So
and with that being said, if somebody wants that technical review, they can email you at Jim Welsh Macro at Gmail. Okay.
Yep.
Okay.
And I'll send it. So I just want to interject that. Okay. So you can see there's a downtrend line that the dollar attempted to get above, did briefly on the knee-jerk reaction to the headline jobs number, and then it's fallen behind, but below it. Again, I still see 5 waves down. So I think the odds of the dollar dropping below 100.62 are relatively low. I think that what we finished was a wave A of a bounce in the dollar index, as we've talked the last week or two. The expectation is I think the dollar is going to rally up to 104 in the first quarter. I thought we would see a lower low. We got it, and it looks like 5 down. So to me, this is likely wave A. Well, this pullback that's happening, I think, is very likely to hold above that last low at 100.62. And then I think we're going to see another push higher in coming weeks that does, in fact, take the dollar up to 104. The thing I would say is the 5-wave decline that looks pretty clear implies that when this bounce is over, I think there's another leg down in the dollar index that potentially will take it, mid-90s. So,
Wow, I mean, that would be a pretty big decline, and I have to say, to see that happen, and let's say your 17-year cycle plays out, it's difficult for me to see that in my mind, and I'm sure it is for other people too. But hey, your charts are your charts, right?
well, in most of those 17-year cycles, there was a recession associated with that cycle.
Yeah.
So again, we've got the majority of economists don't have to worry about a recession now. They were all dead wrong a year ago. Again, I think the lag effects are going to catch up with the economy as we move deeper into 2024. The other thing is we live in a very dangerous world. So geopolitical risk, the risk of war expanding in the Middle East and pulling the U.S. in, those risks are on they're in an uptrend, so it could be that kind of an event as well. I just believe that if the economy slows materially, that is bearish for the dollar.
All right. Well,
and negative for the S&P because earnings are not going to be up 12%.
Right. That's a fair point. So that must mean you are very bullish gold, because gold it's kind of stalled. Silver and gold have both kind of played a little bit of a stalling this week. What do you make of that?
Well, we talked last week, and I'm a little like, okay, given the amount the dollar has fallen, why hasn't gold done more? I thought it had to hold 2010. It did. The low this morning after the jobs number was 2031, and it's rebounded. If it can get above 2089, then I think it's going to rally above 2122. So my expectation is that we're going to get that move. If I'm right about the dollar pulling back a little bit more, then that should provide a tailwind for gold. My guess is that once we get above 2122, that will probably mark some kind of a intermediate term high, and we'll see more correction taking place. But ultimately, I think in 2024, gold is going to 2,300.
Wow.
It's been my bias.
That's a very, very big call, Jim, and it should be interesting to see if it plays out. So, how's that going to correlate with yields, or is there going to be any correlation?
Okay, as you know, late October, I thought we're set up for a decline in Treasury yields. We got it. You can see 5 waves down on the Treasury yield chart. All right, which told me, at least from my perspective, that we were going to see yields tick up for a period of time. I think we finished the first part of that retracement of the big decline this morning. So in other words, 5 down implies that, okay, we're going to get a retracement where yields tick higher. Then that 5 down, from my perspective, implies we're going to see another big decline in Treasury yields after this uptick that takes place. And again, what comes through to me in all these charts is at some point in time, the economy is going to weaken more than people expect. And that's why I think the 10-year Treasury yield will get down to near 430. This chart doesn't go back far enough. I shorted it a little bit, but the low I think in April of 2023 was around 3.25. That's wave 4 of lesser degree. Ultimately, I think we're going to get close to that 325.
Wow.
Again, it's all predicated on, oops, we're not going to avoid a recession. We might actually have a recession, and that's what will drive Treasury yield. So in the near term, wave 4 of lesser degree is the 425 to 430, and that's why I've been focusing. Underneath that red number 4, the yield high there was I think 429.
Yeah.
So that becomes an obvious target for Treasury yields on this retracement. But once this retracement is done, I think we're going to see another significant decline in Treasury yields.
Well, that should be really interesting. And going into the last chart would be your S&P, because
Yep.
the S&P has been pretty bullish all week. I mean, well, actually, I take that back. We've had a little bit of a pullback, but we pulled back to like some pretty, good support, big breakout
Yep.
point. This 4,700 level has been very big. We dipped below it. And what do you think here?
Well, again, when we talked last week, my expectation was that we would see the S&P drop below that 4697. That was wave A, as I had marked on the chart last week. The rally to 4793 was a B wave, and we were going to see a C wave undercut 4697. Obviously, that's exactly what's transpired. It's important that we hold 4688. If the S&P can get above 4730, that's the last 2 little rally highs we've seen, topped out just under 4730. So getting above that, to me, then would kind of point the way we're going above 4818, which was the January 2022 high. So that's the layout. So, but it's important that it hold the low that we saw yesterday at that 4688. In order to have this move. Now, we get up to new highs, Blake, and to me, we're going to make a high in the S&P that I think will then, be followed by a decline of 3 to 5%, maybe more, but at a minimum, 3 to 5% as Treasury yields work their way up and Wall Street digests that, hey, the Fed isn't going to give us as many cuts as we expected and so forth. So it's, and then, as I discussed, I think it was in the monthly January macro tides, historically, and this is one of the things I'll be looking at in terms of that 17-year cycle, is big divergences on the advanced decline line. In other words, prior to most major bear markets, prior to the 1987 crash, 1998 big decline, the AD line did not confirm higher price levels on the S&P. So that's one of the things worth really paying attention to this year is, do we get a pullback, which we just have? The S&P goes above 4818, and does the 80 line confirm, or do we see a small divergence? That, to me, will be a signal that the market then will be vulnerable to at least a 3 to 5% pullback.
All right. Well, Jim, I think next week is going to be a very big week. I think the CPI data is probably going to, or you're going to have quite a bit to talk about when we meet next Friday. So if you all enjoy what Jim does, make sure you show his appreciation by sending him an email, jimwelshmacro@gmail.com, and ask him for his most recent technical review, but also give him a big thumbs up and subscribe to the channel so you don't miss any of these exclusive interviews only here on Trader Summit. So, Jim, I want to say thank you. Happy New Year to you and your family. I'm so happy to be able to do this again with you.
Me too, Blake. And here we're going to do our best to help people, because this year I think is going to be crazy.
I agree. I think 2024
Sadly.
volatility is going to be high, and I'm glad to have you here, shepherding the way.
Next week, I'm going to show up with a staff.
There we go. All right, Jim, thank you so much, and we'll see you next week.
Welcome. Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.